Welcome to the fixed income market outlook for the month of October. As you all know that September turned out to be a very volatile month, and finally there are signals emerging of the ultra loose monetary policy that has been followed for the last 18 months. For that, the process of unwinding to begin. The month started on a positive note following the Jackson Hole Symposium by the Fed, where there was no clear indication of the tapering. However, the FOMC meeting for the month of September turned out to be the turning point for the markets. The Fed suggested that it will start the process of tapering sometimes later this year, and the process will be completed by the middle of the next year. That led to the markets interpreting this as to be more hawkish than what was expected, and the bond yields in the US went back to higher than 1.5%. They're trading at around 1.2, 1.25 before the Fed gave this direction. The dot plots also suggested that the first rate hike may happen in 2022. As we all know that the Fed is the mother market for all the global monetary policy, and therefore the rest of the central banks also picked up clues from there. We had the Central Bank of Norway, Central Bank of New Zealand, and the Central Bank of South Korea, the three developed market central banks which raised rates during this month. Then the Reserve Bank also started accelerated liquidity normalization process. As was indicated in the last policy of the Reserve Bank, the daily variable rate reverse repo amount was enhanced to 4 lakh crore, and on top of that there were one-off variable rate reverse repo auctions that the RBI announced, and the cumulative amount that the Reserve Bank mobilized through this route worked out about 5 lakh crore. There were a couple of auctions where the cutoff was higher than the market expectation. In one of the auctions, the cutoff was at 3.99. So it seems that the unwinding process for the ultra loose monetary policy that has been prevalent for the last 18 months since the COVID broke out is about to commence. In the monetary policy announced on 8th October, the Reserve Bank further enhanced the variable rate repo amount to 6 lakh crores in a gradual way. The cutoff for the auction on the policy day for the variable rate reverse repo was again at 3.99%. So the indications are there that the short-term rates are likely to inch up as the operative rate shifts from the reverse repo rate to the repo rate. At this point in time, the global central banks remain very cagey and a little bit tentative. Most of them are concerned about a possible third wave, which may need for them to reverse these measures again. So therefore, they don't want to unnecessarily put the markets through a round of volatility. As also the growth concerns are still prevalent amongst major economies of the world. The number of COVID cases have begun to ease out in US, but rest of the world still sees a reasonable number of cases with the Delta variant. Even though the vaccination process have picked up, the number of cases in UK, for example, are closer to 40,000 crores as we speak. And therefore, the uncertainty remains. However, it seems that the interest rates are likely to start inching up going forward. The inflation in the US in particular continues to remain elevated, with the oil prices having gone to $83 and more now. The risk of the inflation sustaining has increased. Given that, our view is that the yield curves will continue to flatten across the world, which means the short-term rates will tend to inch higher. The Reserve Bank has done away with the government securities acquisition program, which shows their comfort with the current levels of interest rates, and therefore we feel that the short-term rates will move up more than the long-term rates. Interest rates are likely to inch higher, and therefore at this point the money market funds and the low duration category funds are the ones which will possibly be suitable for the current interest rate environment. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.